Okay, let's get started. Before we get going, can you guys let me know that you can hear me and see my screen, please? Just give me a confirmation that you can hear me and see my screen. Put a yes in the chat, a thumbs up. Okay, fantastic. Got a decent number of participants in the Zoom chat. So thank you for attending this live session. Let me switch over. Just give me a moment before we get started. Okay, so what's going to be taking place in this session? So I'm going to do a weekly market brief, and that means that we're going to discuss what took place last week, discuss some of the key catalysts that are driving market conditions, and then thereafter, we'll look at the week ahead, what to expect for the week ahead. Now, let's just start off with, let me just switch screens over here. Let's come out of this. I like this image here. And the reason why I like this is because, you know, we've seen a large correction occurring in the markets. Some may even call it a recession. I announced a recession a few weeks ago. This is where we're heading. Now, the question is, we've had a bit of a correction in the markets. Markets are, somewhere between 15 to 25% sell-off. If you're looking at the US equity markets, depending on S&P 500 or the Nasdaq, which is faring worse across the board. But now, are we starting to hit, are we seeing where there is now markets steadying slightly, moving slightly sideways and looking for a bounce? Are we seeing sort of some liftoff occurring and markets looking to recover, almost a buy the dip fashion? Or is this going to be a dead cat bounce, which is a bit of market recovery, a bit of a bullish incentive, and then all of a sudden we see an influx of sell orders coming into place? Now, we can discuss that as we go along. That's something that we'll sort of highlight as we go along. But what I would suggest is just be wary. Just be wary, right? So you must ensure that, let me just have a look here. Yep, I am. Okay. Yes, I am. Yeah, so just be wary of market conditions. Now, in a market conditions such as this, where I'm going to highlight some key points, but it's pivotal to understand that markets are not moving in one direction no more, right? There's a lot of themes and catalysts from a fundamental and geopolitical standpoint, but at the same time, market conditions are faring for the worse. If you look at earning reports, geopolitical factors, fundamentals, so sort of key valuations of companies as well. So that's something I'll be looking into recently. I'm going to share some key information later, but just in this state that we're in currently, look to manage your risk. Risk management is probably the most important part to trading in these types of market conditions. Don't go over risk. Don't risk more than you should. Okay, so look to reduce risk as there is a great amount of volatility. So maintain good risk management as you trade on an ongoing basis. Okay, let's come out of this screen over here. Let's move on. So what I might begin with is US equity markets. Okay, so if we're looking at sort of the Asian session as we start this new week, right? So it didn't fare so well from the Asian session. Okay, so initially we saw some gains despite it being a very choppy session, but overall Asian sessions fared worse than expected, largely due to what I'll bring up is the economic calendar here. We'll probably highlight just today. We had in China, retail sales year over year came in a lot worse than expected. Okay, so the forecast was a negative 6.2%, came in at minus 11.1%. Okay, so it's a key factor to take away, especially with what's going on in regards to COVID. Right, so if I just bring this up for here. Yep, China's economic data disappoints in April as COVID controls are weighing in. So retail sales slumped to 11.1% in April from a year ago. That's a much larger decline than the Reuters poll. Industrial production also dropped at 2.9%. The unemployment rate in China's 31 largest cities climbed to a new high of 6.7%. But even though we had these pessimistic numbers, and they were expected to be pessimistic. We see markets fall slightly in the Asian session. But what I should also suggest is that Shanghai City announced Sunday that it would start to allow restaurants to reopen gradually, and said Monday the city aimed to resume normal production and life by the middle of June. So there is some incentive that we're coming out of these restrictions that we've seen taking place in China. Okay, so negative news initially, if you look at what's taken place, but that's for the previous quarter, that's for the year-over-year figure. But going forward, there is indication that we're coming out of restrictions, which could be seen as positive as well. So apart from that, apart from the China data, this morning's market session started off a little bit neutral, started off more to the downside, if anything, because of the negative data. We'll come back to the economic calendar in a minute or so. What I might bring in is the FTSE 100. Looking at the FTSE 100, looking at the daily time frame, that's what you're seeing, sort of the daily candle at the moment, 1 hour time frame. We've had a large push to the upside. We've seen a bit of a mixed trading session. So going into sort of the weekend and then opening up from the weekend, we're seeing mostly markets are neutral at this point of a hair. Now, last week's trading session was majority driven by, Powell and comments around what Powell has stated. Now, what we're seeing is, and that's why we saw a large sell-off occurring in markets, and we had on Friday a bit of a pullback. Comments from Jerome Powell stating that the effect that it will be difficult to avoid a hard landing. It will be difficult to avoid a hard landing, right? Meaning that the hope was that the central bankers, Federal Reserve, will look to, raise rates and, also manage a soft landing to occur where markets continue to grow in economic activity. But it just seems that they're finding it more difficult to have a soft landing. It's going to be more of a hard landing occurring in the US economy, which dented sentiment. Sentiment came across extremely negative based on that point being made. And overall, we saw equity markets fall. And, it just continued to build up. And that's why we've seen these losses occurring in equity markets. If we come back over to, let's have a look at S&P 500. What I might do is S&P 500, go to a 5-day view. That's what you're seeing over a 5-day view from last week's session. So even if we go back to the 4th of April, where we had that large drive higher, then we had the rate hikes that occurred by the Federal Reserve. From that point onwards, it's been in a downtrend. Okay, been in a downtrend with a bit of a pullback from the 5-day session, but at the moment, we haven't broken prior highs. So I'll be looking at breaking the highs of 40-40 handle if you're looking at the S&P 500. Coming over to the Nasdaq, something I might actually do at this current moment, if we maybe switch back to the daily time frame and look at sort of the percentage loss so far, right? So taking it from the all-time high down to where we are at this current moment, we're seeing a 16.86% of a correction so far. So still in the correction phase. But if we take it from the highest point, all-time high, down to the lowest point so far, pretty much on the verge of testing that 20% recessionary level, right? So it just bounced above that level. Now the question is, are we going to breach through this? Now the S&P 500 is the key equity markets that's used as a benchmark for hedge funds that they want to beat, right? So it's the most important equity markets across the board. So coming back over to the Nasdaq, which of course has a much larger correction occurring. Let's look at from the highest point down to where we are at this current moment. It's around 26.5% of a correction, and we've seen at the lowest point almost a 30% of a move there, 30% correction of a move so far. Yes, so equity markets, if we're looking at as a whole, the ones that are being impacted the most are the ones that have companies or constituents within that equity indice, right? That comprise of high growth assets. That's what you're looking at, high growth companies. That's why we're seeing, for example, US Nasdaq 100 tech companies having the largest of move to the downside in comparison to the S&P 500 and in comparison to the Ftse. The Ftse is actually faring rather well overall in comparison to where the all-time high is. So if you take it from the all-time high being in this region there to where we are at this current moment, so we've seen a 6.5% or almost a 6.5% correction. So it's not much. So the FTSE 100 is still faring quite well, but I do believe one of the key points to the FTSE 100 is we're seeing a lot of weakness in sterling. So put an emphasis where you see inverse correlation between equity and its currency. Now, the spread between the dollar and the pound is 10% now. There's been a 10% reversal that we've seen of dollar strength and, of course, sterling weakness. So yes, that's sort of the equity markets and the overview of the equity markets there. Any sort of key points that I want to also mention is maybe if we come back over to the dollar index, just a quick look at the dollar index. Dollar index quickly sort of tested the 105 handle, was pushed back slightly. The dollar remains strong. It continues to remain strong, and it's likely to remain strong as we continue to hear Federal Reserve is going to look to continue to raise rates, right? And Powell has confirmed. He has confirmed one key point, which is in the upcoming 2 meetings that you need to be prepared for a 50 bips rise in interest rates. Okay, so if we see a 50 basis point rise for the upcoming 2 meetings, we're going to see more of a bullish sentiment in the dollar index. We're going to see certainly dollar strengthen over the upcoming 2 meetings. Now, one key point to mention from this is that Powell has suggested that they are unable to tame inflation. Inflation can also reach double digits as well. So, you've got to continue to watch out for the inflation figures that are coming through. Let me just admit someone to the room. Okay, yeah. Okay, so what are we seeing then? Okay, so if we just try and put this in some context, right? We're seeing putting geopolitical factors to one side, just focusing on inflation, right? You have inflation, which is unable to be controlled by the Federal Reserve. That's what it looks like now, right? Initially, it was said that it was transitory for many, many months. Then they said they could quickly control it by raising interest rates, but that's not still having an impact because you've got, supply shortages, you've got, supply chain issues, you've got commodities outrunning and fair values. So inflation is here to stay. It's likely to hit double-digit figures. Now, the question is, what are the Fed going to do? Are they going to look to control inflation so much so that they're going to be extremely hawkish and extremely aggressive in their rate rises? And therefore, we may see that have a negative impact because it's not going to be a soft landing, it's going to be a hard landing, it's going to be very affirmative in their approach. And they're not going to care so much so about valuations or the overall sort of economic activity. And that's why we'll see sort of potentially a recession on the cards there. Now, fundamentally, a recession is by having 2 quarters of negative GDP, right? 2 quarters of negative GDP. We've already had one. We've already had one coming negative, waiting for the second now. But you need to sort of look to be ahead of the game when it comes to trading the markets and trading from a short-term perspective. From a technical standpoint, we are on the verge of a recession, and if not, you can already see that there is a recessionary theme at play at this current moment. I'll come back more into that, but just be mindful of the upcoming what's been announced so far by central banks around the world. I do have something to show you. Just bring it up now. Okay, let me see if I can zoom in as well. There we are. So this is what the outlook is for central banks around the world. Okay, let's start with the Federal Reserve. That's the go-to central bank, right? We're looking at 50 basis point rate hikes in June, July, and September. Then thereafter, they'll switch to 25 basis points rate rise in November, December, and all the way up to Feb of 2023. So almost a 3 to 3.5% is where we're looking at for base rates to be in the US. The ECB are looking at rate hikes, and do note, ECB are one of the most accommodative central bankers, right? Rate hike expected in July and September, plus a possible third hike at the turn of the year as well. Now, the Bank of England We've already seen 4 rate rises so far, back to back. 4 rate rises already occurring back to back. Do note that. But we're looking at another rate hike in June and August before a pause. It's likely to pause because we've already seen a lot more negative numbers coming out in the UK, negative GDP. Unemployment also has risen slightly. So just be mindful of what you're seeing in the Bank of England. The UK might be more likely to be heading into a recession earlier than the US at this moment, is what we're seeing. Bank of Japan remains unchanged and is very accommodative in their stance, and that's why you're seeing where we've seen the dollar yen substantially rise and almost an exponential move occurring in the dollar yen, and that's because we're seeing a lot of yen weakness and a lot of dollar strength, right? Bank of Canada, an additional 250 sort of basis point hikes to 3.5% is what they're looking for, with 50 basis points moves at the next 3 meetings is what is expected. Australia, rate hike in June and July, and possibly monthly to the year end and beyond. Well, okay, I'm not concerned about sort of these 3 here, but they're on the list as well. So if you look at sort of the majors, it's going to be sort of in the top tier over here. So the first 4 is what I tend to sort of view. Then you've got Bank Canada and Australia. So rate hikes are definitely sort of on the cards, and it's no longer seen as, are they going to be in a period of normalization, as in, are they going to go in line with what the market's expecting? It doesn't seem so, right? Which is likely going to have a impact in the equity markets. Okay, coming back over. Now, where do we go from here? Where do we go from here? Okay, so what I can also go into is this here. Now, these are your possible scenarios. Okay, these are the possible scenarios. Okay, we have 3 central scenarios ahead of us. All can be described in terms of economic growth, inflation, and interest rates, right? So we're not applying any geopolitical factors at this point. This is purely based on economic growth, inflation, and interest rates. Now, soft landing, we know already the Federal Reserve, Jerome Powell, has stated it's likely to be a hard landing. So this is less so, but we're talking about, we've got to sort of bring it on board as a potential scenario. So the Federal Reserve and other central banks succeed in bringing inflation under control quicker than most anticipated and don't have to raise rates as far as many now fear, while growth slows down a bit, but never dips into a recession. So we see growth slowing down, right, but we don't dip into recession. As I mentioned, you need 2 negative quarters, okay, 2 negative quarters of GDP for it to be confirmed as a recession, right? We've had 1, but are we going to go into the second now, especially if you're looking at the Federal Reserve? So that's one option, right? But we already had Jerome Powell stating this is not the case from last week, right? So these 2 is more likely sort of the scenario going forward, okay? So a recession, the Fed's tightening squeezes the life out of the economy swiftly, even as it brings inflation under control. As a result, rates don't rise as much as feared, and instead central banks have to pivot yet again and start easing very quickly, right? That's the post-recession period, right? So we're looking at sort of, a very aggressive stance initially, and then all of a sudden we've hit recession, and as soon as we've hit recession, they need to come off this the acceleration and start to sort of go into the brakes, and that's by applying some sort of QE, potentially QE, or any other type of way of easing their aggressive stance at that moment. So that is the most likely of the 3 scenario. That is most likely of the 3 scenario. I know a lot of individuals have this view in mind. A lot of hedge funders have also spoken about they will come off very quickly towards I'm not going to give specific dates, but that's a sort of going view at this current moment. Stagflation. Now, stagflation, this might be dependent on where you are, what countries you're referring to. Stagflation is more likely in the UK than it is in the US. Let's put it that way, right? So what is stagflation? So inflation keeps rising despite central banks' best efforts, and that means rates also keep rising. Inflation combines with higher rates, destroys demand, so the economy submerges. So GDP, economic activity, all are impacted by this, and that's the kind of sort of environment we could be in potentially if we're in a stagflation period. Okay, and stagflation could be persistent, it could be for a longer period of time. So it's up to you to decide. It is up to you to decide what you feel is the best scenario from here. Okay, right. Coming back over, let me just switch over. Ooh. Okay. So, is there anything else that I wanted to discuss? Before I go into some of the sort of other markets here, so you can see cable, look at the daily time frame, look at the drop that we've seen, now testing 122.38 handle. It got to a low of almost the 121.50 handle at one point, right? Sterling yen is moving lower at this moment as well. So there's a lot of sterling weakness, and yen is gaining, especially from last week's trading week, where there's a lot more risk on. When there's risk on, you see a lot more yen strength taking place. But dollar yen seems to be moving sideways. It did breach through the prior low. It did breach through this prior low, right? But it's back above that now. Euro dollar also on the slide with the geopolitical factors, right? And let's go on to some of the most recent geopolitical themes from the weekend and from last week. There are two. I'm just checking that. Is there anything I've not missed out? No. Okay, there are two. Okay, I'll cover that in a minute. Bring this back for here. Yes, so there are two of EU's traditionally neutral members, Sweden and Finland, took a further step towards NATO membership over the weekend. Okay, and it's a historic shift. If you think about, they're on the border of Russia, and you know what Russia's line is, a very hard line. They don't want US and NATO troops on their borders, right? So it is important. And why have they taken these steps? So it certainly is due to Russia's invasion of Ukraine. It is why they've taken these steps now, right? One, they've seen that, in fact, Russia has not dominated the entire invasion period, okay? It seems like the battle continues to go on, and it's going back and forth, back and forth. Ukraine are holding firm. There's lines. Well, maybe not Crimea or the Donbass region, but sort of other regions within Ukraine, yeah? And that's allowed others to also seek safety and also see this as, hang on, we're in new times now. We can be part of NATO. We can be part of NATO. We have not only the military backup if required, if something occurs, but at the same time, these sanctions that are placed, these economic sanctions that are certainly hindering Russia from making larger steps, shall we say. That's right. So yes, I mean, the question is, how would Putin react? What is Putin's reaction going to be to this now? So just keep a loop of what's taking place here. Another key point will be is there are going to be foreign ministers gathering today in Brussels to discuss how to help ease Turkey's concerns to the two potential additions to the military alliance as well. So it's not just Russia are concerned about this, but it seems like Turkey's also concerned about this as well. Now, to flip this, the other side of this will be other sort of geopolitical factor that I'm looking into is this EU embargo of Russian oil, right? What's holding it, right? It seems like it was going to go ahead. Now it's not going to go ahead. What is the key points there? So EU ministers will aim to overturn Hungary's resistance to joining the EU-wide ban on Russian oil. So it's Hungary that's, originally it was Hungary, Germany, and there's a few other countries, but now it just seems that Hungary is the only one that's not going ahead with this ban on Russian oil. Now, diplomats will become frustrated very quickly if this is not resolved, because we've seen 6 rounds of sanctions being applied to Russia, and they're looking to apply another one so that they can sort of allow Russia to recede where they are at this current moment. But yes, Hungarian Prime Minister Orbán's refusal to make a clean break with Russia has diplomats worried that this could risk the EU looking fragmented when trying to put up a united front against Putin. Okay, so that's one of the key factors here. Taking this away from the oil theme, as well as sort of the invasion as well. Something else that caught my eye over last week and the weekend was India looking to ban wheat exports. Okay, India looking to ban wheat exports. Now you might be asking why, but there is certainly a food shortage. Do remember, Ukraine is a large supplier of wheat globally as well, right? So yeah, it's just there. It seems that citing rising inflation and also lower crop yields is two big concerns here. Okay, rising inflation and lower crop yields is the biggest concern here. So the global wheat supply is already tight because of what's happened with the war in Ukraine. But at the same time, it seems like India's looking at Sri Lanka and the unrest due to shortages leading to a state of emergency as well. So there is certainly likely to be a food crisis, and it's been spoken about many times amongst economists. But this is more likely to be the next sort of theme to take place, more likely in 2023 and 2024 of a food shortage. Just to highlight top shippers of wheat. I have that here as well. So we have Russia. Russia sends out a significant amount. They're number one, then it's the EU, then it's Australia, US, Ukraine, and then you have Argentina, Canada, and then India. Okay, so that's what you're seeing in regards to wheat exports. So those are sort of the two key geopolitical sort of factors that I can sort of convey at this current moment. Of course, keep in touch with sort of incoming news taking place, right? Right. So moving on. Something else that also caught my eye was this, and something that I've mentioned before, but Goldman cuts its US growth forecast, saying a recent tightening in financial conditions will persist as the Fed hikes rates. Economists see GDP growing 2.4% in 2022 from a prior 2.6% forecast and 1.6% in 2023 from 2.2%. Goldman's Lloyd Blankfein urged companies and consumers to prepare for a US recession, telling CBS that it's a very, very high risk. At one point, I'd shown a graph a few weeks ago that the probability stated by a couple of institutional banks of a recession at this current moment is somewhere between 30 to 40%, okay, 30 to 40% probability. So yes, there is that fear, as I've highlighted. I might also want to show you this as well. So this is from my Twitter feed from Charlie there. So this is the second worst start to a year for the S&P 500 in history. Negative 70.4% in the first 90 trading days. Okay, the second. Last time that occurred, or worse, is 1932. Yeah, so this is going back to the times of the Great Depression in the US. So negative 26.1%. Now we don't know sort of the year end or the full year at this point here. So this is from 91 days to year end, and this is for the full year. We don't know these figures. We don't know if there's been a recovery. You can see that the 1932, first 90 days, 26.1% of a sell-off. And then markets recovered and made up 15.3% at that point. Not a full recovery, but we had some recovery. But then year to date was down, of course, right? So that kind of goes in line with what we're seeing sort of, at this current moment, possibly, that we may see the next 60 to 90 days, bit of a recovery. Well, there are a lot of factors that concern at this moment, as I've mentioned, okay? A lot of factors that you need to be aware of at this moment. Now, this is what it looks like. Yeah. Will there be more blood? Okay, well, that's a reference to a quote by Rothschild many, many years ago. When there is blood on the streets, that is when you should look to buy. The question is there going to be a continuation of blood on the streets, right? So far, if you're looking at historically, this is what you're seeing here, right? So the Great Depression, this is 1929 to 32. That's how long you see, look at the trading days since peak close, okay? Almost 700 days of sort of a downturn of and then you've got 2007 to 2009. This is your, global financial crisis. Again, just coming up to 400 days. And then the 2000 also very persistent there, over 600 days, or 600 to 700 days there in that region there. We're very sort of in the early days of are we in a decline? Are we in a downtrend? Are we in a recession, right? So it's still very early days. But yeah, this just gives you sort of a perspective of how long do recessions last for, right? So it seems like some of the largest ones have been somewhere between 300 to 700 days or 300 to 600 days range. If you're looking at sort of, some of the largest ones occurring. Okay, fantastic. So that wraps up sort of all the key points that I wanted to discuss with you guys today. Yeah, I'll be happy to take some questions if there are any questions. Thank you for joining in this session. Stay in the room. Stay in the room. If you have questions for me, I'll be happy to address any questions. Just give me a moment, and let me just shift my screen